This segment sponsored by Foster Financial. Welcome to Women's Wealth Wednesday, where we provide you with financial advice about retirement and investing specifically for women. And joining me today is Foster Financial's Vice President, Caleb Doan. Good morning.
Good morning.
How's it going?
It's going well. How are you doing?
Good. Okay, so we're continuing this conversation about spousal inheritance planning. And I know last time we talked about investing in an IRA.
Yeah.
So what type of account will we talk about today?
Yeah, so today we're going to talk about inheriting non-qualified brokerage accounts.
Okay.
So of course we talked a little bit about inheriting IRAs, and I think the reason why it's helpful to talk about this is because there's projected to be this really massive wealth transfer over the next decade where trillions of dollars is going to be exchanging hands from spouse to spouse or even from spouse to kids, and women are going to be the largest beneficiary of that. So last week we talked about IRAs transferring, and there's specific rules about how long you have to kind of withdraw money and all of that kind of stuff. Today I wanted to talk about non-qualified accounts transferring. Okay. And the example of these accounts would be like an individual account or a joint account. And so these are typically funded with after-tax dollars, and they're subject to capital gains taxes, which we talked a little bit about last week on Money Mondays. But as a quick recap, capital gains, an example of that would be, let's say a husband buys a stock for $100 in his individual account, and that stock then grows to $150. He would have an unrealized $50 gain, and if he were to ever sell that, then he would have a $50 realized gain, and he'd owe taxes on that. So when these accounts are inherited, when an individual account is inherited, let's say the husband owns it, the wife is the 100% primary beneficiary on the account. When that account is then passed to her, it gets what's called a stepped up cost basis, which is a huge benefit for the inheritor.
Okay, what does that mean?
Basically, it means that for her cost basis, what she paid for the stock, is considered to be the exact same price as the day that she inherited it. So the husband, he paid $100 for it, it grew to $150. When she inherits it, it's as if she had paid $150 for it. And so she could immediately sell it, and she would owe nothing in taxes.
Wow, that's huge. I'm like,
Yeah.
ooh, listen, now the tables turn, because when we were talking about the capital gain, you're mentioning that you do have to pay taxes on that earned amount. But one question about that, is it the same tax bracket that you fall under in that age range in your current circumstances, or is there a fixed amount that you have to pay in those taxes?
That's a great question. It's kind of both, actually. So the capital gains tax bracket is always lower than what your ordinary income tax bracket is. If you're in the 12% tax bracket or lower for ordinary income, your capital gains tax is actually 0%. If you are higher than the 12% tax bracket, which most people are, it's 15% is what your capital gains is. So, the next tax bracket after 12% jumps up to 22. A lot of people in their working years are in the 22% ordinary income, and their capital gains is just 15. So, but yeah, if somebody's in the 12%, we often take advantage of that and say, hey, we can free up this stuff without paying any sort of capital gains.
Who is in the 12% when you say that?
Yeah,
exactly. Who falls under there? That's a great percentage to be under. Okay,
yeah.
So when they inherit this individual account, tax-free, or they get it the way that it came. Now, if they have more earnings after that, if they keep it in the stock, then what happens?
Yeah, if they have more earnings, let's say the wife inherits the stock, it's $150, then grows to $160. Yeah. If she were to sell, she'd owe taxes on that $10 gain.
Okay.
But, theoretically, the day that she inherits it, she could sell out of everything, rebalance it, whatever she wants to do, and wouldn't owe anything in taxes. The really unique thing that I think most people forget about or kind of gets pushed away is if you have a joint account.
Right. So I was going to ask, so what happens in that case? And that would be a joint where both the husband and the wife are both owners.
Yeah.
So what happens then?
Yeah, that's a great question. So basically, let's say both of them bought that stock for $100, however many years ago, it's now $150, and then the husband passes away. Those joint accounts, just the surviving spouse just retains the entire account. You get a 50% stepped up cost basis. So your cost basis instead of 100 would go up to 125 in that scenario. The really important thing to remember though is that this doesn't happen automatically. When it's an individual account going to a new beneficiary, an entirely new account has to be established because that individual account was in somebody else's name. It needs to go to the beneficiary. And so typically brokerage firms will automatically give you that stepped up cost basis. When it's a joint account, the account doesn't need to change hand. It stays in the same account number, everything. And a lot of times brokerage firms won't automatically give you that stepped up cost basis or that 50% step up. You have to request it. And very few people know about that step up in cost basis. And so of course they don't know to actually request it.
Wow.
And so
There's
then if
so
they
many little nuggets.
Oh yeah.
There's so many little, what is it called, when you just have to kind of go around about to get all your benefits.
Right, I know. You have to kind of advocate for yourself and know a lot of these things. And so, I mean, it's often where we'll have a new client come to us and, you know, they'll say, hey, my husband passed away a couple years ago, left me this account. I'm not really sure what to do with it. And we'll see that it never got that 50% step up. And so we'll go back and help them with that and then save them a lot in taxes over the course of their life.
Yeah, good stuff. They got to start planning now, though, to get all the benefits.
Yeah, absolutely.
All right. Thank you so much, Caleb.
Yeah, thank you.
And if you would like more information about Foster Financial, we'll be sure to have their website and phone number listed below to give them a call. And we'll be right back. This segment sponsored by Foster Financial.